Hey, what up, guys? This is Kevin here with Real Traders Webinar. Sorry we started a little bit late. A lot of people are still rolling in. If you guys could just do us a favor and type in the chat box if you guys can hear us okay, and if you could see the screen. If you guys could, all right, great. Okay, guys, so tonight what we're going to be doing is we're going to have two presenters. We're going to have Mark Nicholas and Kevin M. from Maryland Capital Management, and they're going to be teaching you guys how to master credit spreads. So this is going to be a two-part series. Tonight's going to be part one, and next week we'll be doing part two. So what we're going to do is I'm going to allow Mark first come on and introduce himself and tell us about his experience and what he's been doing, and then we'll let Kevin do it, introduce himself, and then we'll take it from there. So, Mark, you there?
Yeah. Good evening, everyone. Can you guys see our screen? Apparently, I don't have my presenter right now. Do you guys see the PowerPoint, the first slide? Hold on. So I'm going to go like this, and that'll be easier for everybody. And roll like this, I guess. Everybody sees the PowerPoint? Okay, thanks, Tom, Paul, Roger, Richard, everybody. Everyone, good evening. My name is Mark Nicholas. I'm the founder of the daytradingzones.com, and also I am a trader just like you. I've been a trader for the past 20 years. I started in the prop shop environment and also worked for a small hedge fund called JP Capital, which was a division of Endover Trading in South Florida. Tonight is very exciting for us because I am also one of the contributors of Real Traders Webinars. We have Kevin, who is also an hedge fund trader. He trades private funds and does a lot of options. And we are very excited really teaching you tonight and sharing with you guys a strategy that is a simple strategy, yet it is a strategy that has a 68 to a 95% chance of success. And that when you look in the scheme of trading and all the statistics of traders losing money, this is a strategy that really can change your life and your trading all around. And we are really excited to share it with you guys tonight and next week and try to give you really the steps and processes that we do on a day-to-day basis where we trade real money with this. So Kevin, if you're around and you want to say a word, that would be great.
Hi, welcome everyone. This is Kevin M. I'm really happy to be joining Mark tonight. There's a lot of information that we can pass on. I've been trading for 10 years. This is my 10th year now, and want to help everybody overcome the learning curve and become successful traders.
Okay, great. So we're going to start and try to give you an idea. First, we are going to progress on this part one of what is really a spread. You know, why should I do a spread? Why a spread, an option spread, and what is an option spread? So we'll go through the definitions, the break-even points, the maximum loss, the maximum profit on the spread, and we'll look at charts together and show you how we structure our spread with our option chains and how the credit spread is not that difficult of a strategy, and it's a super powerful strategy. So what we were telling you at the beginning of when we started like 2 minutes ago is we as traders have two ways of looking at the market. We can trade any stocks, any forex pair, or any futures at a current price. That's called a bell curve. So don't be intimidated by this. It's a very powerful concept that took me, like, even trading professionally, took me 4 or 5 years to really ingrain as a subconscious, as a second nature of what I do. And this bell curve tells you that here, right there at the top of the bell curve, that's the current price. So if we trade at the current price as a trader, everybody, we have only what, really? It's like throwing a toss and tossing a coin. It's a 50-50% chance. And even if you think you have a great strategy and a great process and you have great support and you have great resistance on your daily basis and in your daily prep, you still have only really 50-50. That's the mathematical model here. But if you look at the range of that stock, any stock during the year, they have a range. It's called the volatility or the implied volatility. If that range is plus or minus 20% of any stocks or any future or any forex that you look, you will see that during a given year, your stocks or your ETF or your futures or whatever, they stay in a range. And that range, when you stay within the implied volatility of the implied volatility is like, let's say here 20% will be from the 100 minus 20% or plus 100 plus 20%. That means that if you trade around that 80 and you trade within that 120, you have a 68% chance of success. So what you've essentially done, everybody, is by trading in those extremes here when you have great support and resistance, and that could be a monthly support, that could be a weekly support here, that could be resistance, sorry, that could be a monthly support, that could be a weekly support, okay? But unfortunately, most traders trade here at the current price with a 5-minute chart, a tick chart, a 60-minute chart, which 60-minute charts are good, but anything below a 5-minute chart, what you are essentially doing, everybody, is you are competing against the high-frequency trading system, everybody. And you are going to be killed. You are going to give the market makers and the professional traders your money day in and day out. But now if you are able to stock trades with a 68% chance to a 95% chance at the extreme of the range of the year on any particular stock, now you increase your probability of success between 68 and 95% chance. And that's exactly what the credit spread allows you to do. It's to do trades within a range, and all you have to be right on, is that if you do a spread between 80 and 75 here, let's say a put spread, and you assume you'll stay above 80, all you have to do to make the entire money on a spread is stay above your break even, which would be 80, okay, minus your credit received here, okay? And on the 120, if you are short at 120, all you have to do is stay below the 120, and we'll show you on the graph with Kevin. So this strategy is great because now look at the support and resistance, and I'm going to show you a graph. Can everybody see my charts here? Okay, quick yes, no. Okay, cool. So if I pull here a weekly chart, everybody, and Kevin and I look at the SPY since 1994 here, okay? Is this fair to assume that this high in the SPY here in 2000 and this high in the SPY in 2007 were very important high? They were resistance. What became resistance became support. As a matter of fact, look, if I prolong here this line, you will notice, and I zoom it with a little bigger line, 3, so you can better see. You can see, and then look at my pen, that what was resistance once with net sellers here in the past 20 years, net seller here, okay? Net seller, net seller, net seller becomes now a net buyer situation where the resistance becomes the support. So what if you had a strategy when this market pulled back around the 150 or the 160 or whatever? What if you had a strategy to do calls around the 155 and the 160 right there? And that strategy allows you to make money as long as prices stays above the break-even point here around the 155, 156, 160. And this is the credit spread. We'll give you the definition, but essentially what the credit spread allows you, everybody, if you're bullish here, it doesn't matter if the stock goes up per your assumption or down, as long as it goes and finalizes itself by expiration above the break-even points for a put spread. Or if you are bearish right now, you could do one at 175, 180. The current price is 167, which would allow you a 5% margin of safety from the current price. And now if we stay below those break-evens, you would make the entire money. The credit spread is the only strategy pretty much that allows you 3 things. It allows you to be wrong in your assumption. If you think it's going down and it's going down slightly and then going back up, as long as it stays within your break even, you still make the money. It allows you also to stay sideways and you still make the money. And of course, if you are right, it makes the money. It has also a very important element is that when you do a credit spread, you are a net seller of options. And I will show you in the PowerPoint an option, and this is where everything is being derived from understanding options and how you are on the right side of options for maximum success, everybody. There's 3 components into an option that you must drill and really understand. There's the time value of an option. There's a real value of the option above a strike price that you choose. And there's a volatility component. Those 3 elements represent your total premium. So if your total premium equal $1 and you look at an SPY option for $1, you can be sure that that $1 is split into those 3 elements. So it could be 30 cents in time value. It could be only 20 cents in real value, and it could be 50 cents of volatility because the volatility is very high. So here's what's super interesting about selling and being a net seller of options. That's where 90% of the traders that make money do. They sell options. The pension plan sells options. The hedge funds are net sellers. And we, unfortunately, the retail public, buy the options. So we are always in the wrong equation because that time value right there, that 30 cents, is worth nothing, 0 by expiration. So if you were to buy a weekly option, let's say on Thursday for $1, the next Friday, assuming your direction is right, your volatility doesn't move, and your real value stays the same, your options will be worth what, everybody? Assuming real value stays the same, volatility stays the same, what would be your term value worth next week by expiration day? Exact, nothing. Beth, Robert, Tom, June, nothing. So essentially, you've just bought an asset for $1 that is truly worth 70 cents if everything remains equal, meaning you have enough velocity above your assumptions going up or going down, and the volatility remains the same. So essentially, the buyer of option got, excuse my French, he got screwed because they bought an asset for $1 that is truly worth 70 cents. So they bought an asset that was 30% overvalued. That's why the people that make the money, everybody, are the seller of the options. Because that 30 cents, what happened if it's a weekly options, so it's, let's say it's open on Thursday, Friday, Monday, Tuesday, Wednesday, Thursday. And we go again, Friday, right? Did I miss something, Kevin? Thursday, Friday, Monday, Tuesday, Wednesday, Thursday, Friday. Okay, so that 30 cents, if you divide that, let's say, let's make an easy one. Let's say it's 35 cents in time value, right? In time value here. If you divide by 7 days, if you do it in a linear fashion, is losing 5 cents, 5 cents, 5 cents every day. But the truth and the matter, like Kevin pointed out when we did a webinar once together, is that it might be 5 cents on Thursday of time value decay, 5 cents on Friday, 5 cents on Monday, but now it accelerates. Let's say it becomes 10 cents on Tuesday, it might be 11 cents on Wednesday, then it starts accelerating, and whatever it is, as long as you're total, there's an acceleration of time value to the expiration. So this income, this predictable income, which is the theta of the option, the time value in the options, you guys make that money every day. That's predictable income. That's like a rental check. It's like a rental check that you make every day, every week, and every month. This is why the seller of options make the money in this game, everybody. I don't say that Kevin and I don't do directional plays and buying weekly options when we are certain of our directions. But when we do so with a small portion of our portfolio with small sizes. And the reason we do that is because we know that the consistent, predictable money is being done in selling options. And the credit spread is the basic technique of selling options with defined risk for small accounts. Because there's other techniques like selling naked puts and doing other more fancy stuff. But if you don't control and master the credit spread, which is available for everybody, you are not going to master anything. So what is a credit spread in definition? Again, what you do in a spread is very easy. If you are bearish, look at the top of the screen. You sell on a call here and you buy a call above for protection. So if you sell a call, let's say for 70 cents, and you buy a call, so it's a minus 70 cents, and you buy a call for 30 cents, what happened, everybody, is you get a credit in your account for 40 cents. Because the net transaction is you get money. You have not spent money. There's no debit. You got a credit here. And what happened here is that as long as you stay below your break-even, let's say your break-even is 175, as long as you stay below 175, and let's say the current price in the market on the SPY is 167, which, what is that, Kevin? 67 to 75 is about a what? A 5% move? Yeah? Say 8 points? I would say 5%, right? So as long as you have that 5% buffer, everybody, as long as you have that 5% buffer, everyone, you are not going to be stopped, or you are not going to lose money, because you are going to structure, and we are going to show you how we systematically structure those trades with 68% to 95% chance of success on our option chains. So again, a spread, you sell an option, you buy an option. If you are bullish at the bottom, look at the bottom, you could do an SPY 155, 156, or 155, 151, or whatever. Usually we look at 1 point spread, which are the less risky trades when you start spread, especially on the SPY, which is extremely liquid. And so what you would do here, you could sell a put spread, and you would sell a put spread, let's say 155, 154. So what happened here? You sell the put spread at 155, and you buy the one at 154. As the market goes up and up and up above your 155, what happened to your puts, everybody? Is the put premium going up or down, everybody? If the market goes up, what happened to the put premium? And this is the logic of everything. Exact, Robert, Nancy, Richard, Beth. The put premium will go down. And that's what you want because you are a net seller. So if you sell a credit spread for 30 cents, and now your premium goes down, goes down, goes down because it stays above your break-even coming to expiration or going up. Now you might cover this for 10 cents, okay? And now you made 20 cents on a 30 cents a spread. And you made about 66% of the move or 66% of the move here, okay? So this is really how it works. So now, let's go to the definition and let's go back to charts. Is there anything you want to add, Kevin? You there?
Yeah, I'm here. Thank you, Mark. Just on the spread itself, if you have a 1 point spread, then your risk is $1. Okay, so if you have a $1 wide spread, your risk is $1. All right, we're receiving a 30-cent credit. Okay, so we're really risking 70 cents on this. Okay, and that gets back to this. How much is this option really worth? Is it worth the $1 or 70 cents? The 30 cents that we receive is time value, and since we're option sellers, we're receiving the 30 cents, and it's a high probability trade.
And we were going to go like right now with the definitions where you see the break even, the maximum profit, and the maximum gain. So you better understand that this strategy is all about one thing. Look at my pen. It's all about one thing. Can your assumption be right that we stay below the 175 for a call spread in that case? Or if you do a put spread, can we stay above the 155 area? If you have this right, to stay below your break even on the call spread if you are bearish, or a put spread on the 155 if you are bullish. That's how you make the entire money, everybody. And the reason it's powerful is, even though your maximum loss will be superior to your max profit, you have to understand that you are doing structuring trade that I told you that goes with a 68% chance of success to 95% chance of success. And we'll show you how it works. 68% chance of success with 95% chance of success. That is compared with your 50% chance when you do a day trade at the current bid and asks on anything that you trade, an Apple and a Google, an SPY, a price line. Now you increase your odds like a professional. Now you have a real replicable business that we will show you the steps we take every day in our business to structure those.
Couple things, Mark, here. Couple things, Mark, when while you're transitioning over. Let me just say a couple of things. And for you folks in the audience that that are maybe beginners or intermediate option traders, there's one thing about options or derivatives in that my teacher told me that was just like when you're cutting across the lawn. You know, you've got a nice grass lawn and you cut a path across the lawn and you're walking across that path all the time. Well, pretty soon you wear a groove in the lawn and grass never grows there again. And options is like that. As we think about probabilities, as we think about these options and spreads and trading them, it becomes more and more ingrained in your system. And the more you do them, the easier it gets. And so it may sound very complicated now, but if you just stay with the discussion, then a lot of things like the bell-shaped curve and probability will begin to kind of sink in, and then that's one thing. And then that's for spread traders, and also for directional traders, we have got some information that is going to be very enlightening to you, that will help you to choose very quickly the correct option when you're doing directional trade. To choose the correct option for the day of the week and whatever opinion that you might have. So stick with us. Thanks, Mark. Go ahead.
Okay, so let's drill now the PowerPoints and the definition, and we'll go back to charts and we'll take example, guys, and you'll see it's not difficult. What's important, like Kevin said, this can really change a lot of the way you think about your trading and your business, and make your business put the probability of success in your business, in your trading business, versus what you've done so far. So here's are the definitions that are important. You must know that. It's just definitions. You just have to accept them for what they are. Here is what is a spread. So here are the definition of a spread, like I was telling you. It involves a purchase of one option and a sale of another option in the same class meaning, like, let's say SPY, same expiration, let's say the month of July, and at different strike price. Investors receive a net credit for entering the position. The reason we receive a net credit is because we sell one, and what you sell it for compared to the one that you buy it for is higher. That's why you are net credit, and want the spread to narrow to expire for a profit or expire worthless. So again, look at the top. If we do a 1-point spread, we are going to stick to this one, easy one, and you are bullish on the SPY, and you have that spread 155, 156. All you have to do is you sell the put 156, let's say it's July or August, so let's stick to July since we are in July, and let's say you stick and you sell this one for 70 cents. So that's you sell, you receive a credit. Okay, a credit, let's say a plus, sorry, we'll put a plus. And you buy the 155 for protection, the same SPY put, now you buy it for 40 cents. Okay, so it's a debit because you buy it, it comes out of your account. The total transaction is you are receiving 30 cents. Okay? And because you are receiving a credit and you are a net seller, you want one thing and one thing only. You want that net premium on your spread to go nowhere but down as it approaches expiration. So what happened essentially is, like I told you, the way you do that is very easy. On the spread to make money, everybody, is you got to stick above break-evens. Yeah, Robert, Roger, everybody, we'll answer all your questions, even if we have to stay another 15, 20 minutes at the end. If Kevin allows us, that'll be great. But right now, we got to give you the basics to go through the examples. So what happened is, if you sell it for 30 cents, everybody, we got to have this trade, and you are bullish. You want this trade and the price action to stay above your break-even of 156. And I'll give you the break-even max profit. So a spread, again, definition of a spread. You sell one option, you buy one option, and the total of an operation is you get a credit. That's it. That's the definition of a credit spread. So let's go to the max profit, max loss, and you are going to start understanding everything. This number, the break-even, is the most important number that you want to know within your assumption. If you are bullish, if you are bearish, you want to know that break-even point in relationship to your charts. So if your break-even, you look at your charts, like we looked at our charts, and we look at 20-year or what it was, about 20 years chart on the SPY, and we assume 155 on the SPY was a strong support, then we want to take a trade, a bullish trade, that stays above that 155. As long as it stays above the break-even, let's say of 155 minus your premium or whatever, you are going to make the total money on that spread. So here's the definition of your break-even point. To find the credit spread break-even point for call spread. Call spread. So call spread again are the ones if you are bearish. Bearish, why? Look at me. If you have a call here, you sell a call here, and you buy a call here, and the market goes down, 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 everybody. Your call premium goes up or goes down, everybody. If you are at the top of the market and the market starts going down, what are the call premium doing? Up or down? Everyone? Down. Correct. So if your premiums are starting to go down, everybody, on you, and those premiums starts going down, 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 and you sell that thing for 30 cents, so you're a net seller. It's going down, it's going down, it's going down. Now that option that you sold at 30 cents is worth maybe 10 cents, like I mentioned before. Now you can buy back that option for 10 cents, and you just made 20 cents. And you've done so by choosing, and we'll show you like within the next 5 minutes, you choose very carefully your break-even point at a 68% chance to a 95% chance of probability of success in your option chain, that you should overlay that with your support and resistance, your moving averages, your market profile, your MACDs, whatever it is that you use right now to enter and exit trades with high probability of success, you will use that. And you'll overlay that with the option chain. So the break-even here, again, is what? For put spread, it's the net premium subtract from the higher strike to the break-even. And for the call spread, it's this one that you sell at the top here, S1, plus the credit that you receive. Okay? So essentially, so that everybody, because that's very important, the break-even. So let's go back to a chart. Well, we can stick to this, and Kevin, perhaps you can help me reinforce that. If it's a put spread and you are bullish, okay? So let's take the same example again. We are bullish. We take a 156, 155 SPY spread because it's very liquid, everybody. SPY is the first instrument that you want to master. As a matter of fact, Kevin, who has been trading professionally, makes thousands and thousands of dollars every day. Everybody, he trades only what? Mostly SPY, correct, Kevin?
Yes, yes.
So essentially, if you guys want to start somewhere safe and cut your teeth the right way, well, a lot of professionals are, but also they are there because there's a lot of liquidity and the spreads are not large, use the SPY. So if you are bullish, so assumption, bullish, here's what happened. You sell the 156 put spread and you buy the 155 put, okay? And what happened is as the market goes up, goes up, goes up, goes up, goes up, if you sell for a net credit of 30 cents, okay, as the market goes up, goes up, goes up, goes up, that put premium goes down, goes down, goes down, and maybe here it goes at 10 cents. Now you cover it for 66% profit here. So now you know the break even is what? The break even will be the 156 minus the credit that you receive, which is 30 cents. So your actual break-even point is going to be 155.70. Okay? So as long as the market can go up, the market can go down even at 156 and 10 cents, you still make the entire 30 cents, everybody, at expiration. As long as your price, the price of the market stays above your break-even for a put spread or below your break-even for a call spreads, if you are bearish, you will make the entire spread. The most important numbers on the spread is that break-even point and looking for 68 to 95% chance of success, which we are going to show you. So now let's do the same exercise. What would be the maximum gain in this example, 156, 155, that we sell for a credit of 30 cents? What's your maximum gain? Just read the formula and write those formulas and ingrain that as a second nature. So we are going to practice them in charts and charts, because next week when we go to part two, we are going to show you with Kevin like advanced strategy. How do you defend a spread? How do you do an iron condor? If you have a losing iron condor on a losing spread, how do you turn that as a winner? If you do 10 spreads and you have 2 or 3 losers, how do I turn that as a winner? I have a friend that I traded with me back in the days when I was working in the professional firms. He works for a firm. There are only 6 people, and they manage about $198 million. 6 people. All they do all year long, everybody, is they do spreads and naked puts. Nothing else. Spread and naked puts. Spread between 68 and 85% chance of success, and puts between 85 and 95% chance of success, because it's a little more risky, but they have a higher probability of success. And those guys, listen to that, $198 million in asset management. Those guys have, guess, how many losers did they get? How many losing trades they got last year? In an entire year. What would you say, Kevin? Your best guess.
Very few.
What would you say? Just a number out of your name, out of your head.
Maybe, if it's 95%, so maybe 5 trades in a month.
Okay. My friends told me that last year his entire hedge fund returned about 86% return for the year with 6 losses. 6 losses for the entire year selling credit spread and naked put. 6 losses, everybody.
Wow.
And 6 losses because what? We will show you next week when you have a loser, if you roll them over and you buy time and you will sell them for a higher premium, even further out of the money, you still can come out ahead. The only thing is you lock that capital for another 2 months or 3 months. But the bottom line is those guys are looking at annual return. 6 losses in 1 year. Amazing, no? 6 losses in 1 year. A $198 million fund. So this is stuff, guys, that can change your life. And those guys don't have really an advantage on you. The only advantage that those guys have on you is that they have the leverage to sell naked puts. But when it comes to doing like spreads, you can do spreads. The only advantage, again, I repeat, that those guys have on you is they have portfolio margin access, and their margin requirements for everything is much more less than what we have as retail traders if you have less than $125,000 in your broker account. Like if you're an interactive broker, Thinkorswim, or like whatever, TD Ameritrade, if you have $125,000 and more, you can ask portfolio margin access. And then that's another ball game. Now you're entering the big boys club in terms of margin access, but with that margin comes consequences. You need to be really astute on how you use that margin. And those guys use that margin very, very smart, I'll tell you. You know, when they structure trades at 95% chance of success and they roll them over when they have losers, it's a 6 loser for the year. So ingrain those formula. The break even for a call is the low, when we sell a call at the top here, if we sold the 166 here and bought the 167 here, your break even for a call is the 166 plus the 30 cents. So it's the low strike plus the credit. When you sell a put spread and you are bullish, it is the high put spread, the 156 minus the 30 cents. Those are your break even. As long as you stay below that break even or above that break even, you'll make the entire spread. And that's the beauty of those strategies, because if you go 3% away to 10% away from the current price in the market, everybody, you've essentially give yourself 3 to 10% buffer, 3 to 10% buffer in the price to be wrong. That's huge, everybody. Because not everybody is a great trader. Not everybody can trade the bid and ask every day. As a matter of fact, 90% of the traders lose money there. Right, Kevin?
Yeah, that's right. Directional traders are losing money. I mean, the amateur directional traders are losing money very quickly. It's spread traders that by majority are making the money.
And so this is very profound. So know those formulas. Again, break-even points. We are going to take some example right now. Maximum gain, maximum loss. And now we are going to show you how we structure them for 68%, 95% chance of success with option chains and charts. So, and as we go next week, we'll dig in further and further. So let me take that out and go here. So let's go back to the SPY, and we are going to take a blank chart of the SPY just to help everyone. And we can even take maybe an apple or something just to illustrate after as well. So I'm going to take a blank chart so I don't confuse you with our zones, the zones that I use. And I'm going to go here. And whatever you use, that's fine. The key is to understand the process. So let's go back to that weekly chart, everybody, and take again the assumption that the SPY has a very strong support here. Right, Kevin? So that makes sense? Just that line right there, you know? And the reason,
resistance is now support.
Exactly. Resistance becomes support in almost a 20-year chart, 19-year chart right there. See? Resistance becomes support. So if you assume that, then you know that that 156, 155 seems to be a great place to enter a put spread, right? So now what you look here is your option chain. That's the second level. So you start by your charts to find support and resistance that have strong levels and high probability of staying there or not. Now you double confirm by this, and it's easy. You take a simple option chart, option chain. You have a bid, ask for your options on each strike. You have the open interest. Forget about the intrinsic value. I'm not going to complicate that right now. And you have the probability in the money to stay above or below a certain number. The probability in the money, what it is really in an option chain that you have in all the option chains, is a delta. The delta multiplied by 100 is your probability. So the option chain, which is really the market participant on any given day, on any given week are giving you probability of success to stay above and below a certain price. So look, if I look for August with 36 days to go in this option, and I look at the 155 area, okay, what is the probability of staying above 155? So I go on the left, on the left, on the left, on the left, and look what it is. Can everybody see that 85% chance of success? Quick yes, no, everyone. So this tells me, and that confirms our chart, that we are looking for trades, everyone, that has a minimum of 68% chance of success, right, to a 95% chance of success. So if you look at that chart and that option chain, right now we are at 167 on the SPY, so I can advance to the 155. You can look at your option chain right now and look what you can derive from your option chain right now. You can derive that from this 185 to about this number right there, which is the 163. We have all the potential support that give us one standard deviation or two standard deviation in the bell curve of success, which is 68% or 66% to 95% chance of success. So after that, it's up to you to pick the strike price that are going to give you enough premium. So write that down. Now we start getting to the nitty-gritty for the people who are more advanced. If and this is where Kevin can jump as well. SPY, usually I do a 1 point spread. So 1 point spread meaning what? Meaning they have only 1 point spread difference. So I give you an example. If I do a 155, 156 put spread again for 36 cents, for 30 cents, I want everybody to give me again, what is the break-even of that spread, the max profit of that spread, and the maximum loss of that spread. So let's get going. What's the maximum? What's the break-even? The most important. Okay, that's a put spread, everybody. Bullish put spread. Okay, we are bullish put spread. We sell the 156, buy the 155. Sell the 156, buy the 155 for 30 cents credit. So what is my break-even, everybody? Again, you're right. The break-even is the difference of the strikes, which is the 156 minus the 155s, the difference of your strikes minus the credit you just received. Okay? Which is 1 point minus the 30 cents. Not the break-even, sorry. The break-even is the 156 minus the credit received. So it's the 155.70.
So Mark,
now,
just for clarification, guys.
Yes.
Mark is saying it's a 1 point spread. It's also known as a $1 wide spread. Okay, so if it helps the beginners to think of it as $1 wide between 155 and 156, $1. Okay, all right, good. Go ahead.
Okay, so it's a $1 spread, and what you have to do when it's a put spread, you take the 156. Okay, so remember the support and resistance. That's the 156, the high strike, and this is the 155, the low strike. When you are bullish, it's a put spread. You take that 156 minus, so it creates a little buffer of minus the 30 cents you receive, and that's your break even. So as long as I'm taking another color right now, and I know it's a little tedious, but you'll get it, guys. We are going to drill it so much today and next week. You are going to drill it, and we'll do chart blast maybe with Kevin. And I'm telling you, if we can change the lives here of 40% of the people who are here doing this, you will never look at your trading the same. Never again. So like Kevin says, bear really with the conversation. So 156 minus the 30 cents is 155.70. That's your break even. Okay? As long as you stay above that 155.70, so it could go up, it could go down, we don't care. It could go sideways, we don't care as well. All we care in that conversation and that practicality of you making the money is that it stays above that 155.70. And the beauty of this is when you have the current price, let's say at 167 right now, it's like you have a 10% buffer, you know, or a 5% buffer. So like I told you, if you can create 3% buffer from current price to 10% buffer from current price, now you are not gambling. You are trading stuff with an 85% chance of success that has a buffer from the current price of 3 or 10%. And now you're not a gambler at all anymore, because all you're doing is going far enough below or far enough above that you have a high probability of making the money, guys. So Richard says the maximum profit is 30 cents. Yes, it's the credit that you receive. Correct. The maximum loss from Metin is right. It's 70 cents, which is what? The maximum loss is the difference in the spread, which is 156 minus the 155, and then you have to subtract the credit that you received. That's why I started doing above, which is 70 cents. So now everybody is going to tell me, hold on 1 second, I don't understand. You telling me that I am going to make 30 cents if I'm right to risk 70 cents. What's wrong with that picture? That's where the people get scared about spread. People are going to say, I don't understand. You have a 2-to-1 inverse risk ratio. But what you don't understand is, yes, you have a 2-to-1 inverse risk ratio, but look the probability of success. 85% chance of success, everybody. So what you are doing is you're trading, you're taking a little more risk, but you really trading that for a higher probability of success. And that's the entire logic of a spread. You have high probability of success for a little higher risk, but your risk is very well defined. It's that 70 cents, everybody. And what happened is on a dollar spread, if you made 1,000 shares, like one contract, remember in options, one contract equal 100 shares. So if you trade 10 contracts of that puppy here, you are risking $700 to make $300, your maximum profit, but you do so with an 85% chance of success. So every month, if you structure those like this, out of 10 trade, you are going to lose 1.5 trade out of 10. And all of the other ones will be winner. So that strategy mathematically is going to make you money, everybody. But when you have losers, that's what we'll show you next week, and that's the next week more advanced part is how do I get out of a loser? How can I improve the situation of a loser? Right, Kevin?
Good, yeah. So the odds are in our favor as we place these trades, as we sell the credit spreads. The odds are in our favor.
Does that make sense, everybody? This time we flip around the cards. We get the 85% chance of success, and the other trader on the other side, the buyer of the option, gets 85% chance of losing. And as a matter of fact, he goes even more than that because he has the time decay. The time decay goes quickly against them. So they have to fight every day against the time decay. Okay? So let's take some example on the option chain, and we are going to do some real example now. I think everybody's getting into the groove here now, Kevin, right? I see max profit, max loss.
When you're switching gears here, let me just say, can you flip back to that last screen that you had?
On the PowerPoint? Or
yeah, the last PowerPoint that you had. When we're talking about, and we'll do this in the chart review, we'll talk about price action and, no, you're drawing, Mark. Back to the drawing. Price can go up, it can go up parabolic, it can go up sideways, it can stay the same. We as option sellers, as long as price stays above our break even, we're making money. Options are a depreciating asset, okay? Why are they a depreciating asset? Because they have time value. And there's something called time decay that's happening on a continuous basis. The moment that you buy an option, all of a sudden, it's just like a tire that's filled up with air. It air starts to flow out of it. Okay, so if you're an option buyer, then time is not on your side. There is some urgency for price to go directly to the target, and so you can get out. Well, when you're an option seller, hey, price can meander around all it wants. And if you've been watching the price action, we get these overnight gaps, and then price goes sideways during the day. Well, guess what? If you're a spread seller, that is great price action for us, okay? And it's been like this since March of 09, right?
Okay, so let me show something quickly to everybody. We took the example of 156, 155. Obviously, now we are 167, so you're not going to get the 30 cents. The point of the discussion was to show you this, everybody, tonight, is that credit spread allows you a strategy, like Kevin mentioned, that if this is the strike that you choose, 156, 155 in that example with 30 cents in credit. So your break even will be 155.70. What we are trying to tell you and explain to you that you can be maybe at 160, you could do those 160, 161, or if you are bearish, you could do them at 175 at the top, 180. See, you could sell the call spread here, 180, 175. Whatever it is, whatever is your assumption, you have a strategy now that allows you to not gamble, meaning that if the current price is right there, see, that's the last candle, and you can create that buffer above the current price between 3 and 10% above, or here 3 and 10% below, and structure those price with a 68% chance of success to 95% chance of success, you are not gambling anymore, because like we said, it doesn't matter if the price goes up, really, if you have a put spread, or down back close to the break even, or even sideways. What matters is to stay above this break even here, or to stay below that break even here, and you're in a position, you put yourself in a position for the first time in your trading career to understand the strategy that a lot of people don't know that strategy, and it seems so complicated to everybody. But if you bear with the conversation and say, this seems interesting, this is amazing. If I am below the current price with a 3 or 10% buffer, or above the current price with a 3 or 10% buffer, and the market can go up, the market can go down, and I don't care anymore, because I don't have to watch that screen every day. I can structure my spread with high probabilities, and if they go against me, we'll show you what to do next week. But they have a high probability of success. Now you're not gambling. You have a business that can provide you weekly income on the weekly's options and monthly income. And this is huge. This is like having a rental property. The difference is you don't have to deal with HVAC or whatever. This is like a rental check coming every week and every month. So here's is an example we can take. Let's put maybe a chart on Apple. And we are going to start looking at Apple, everybody. So you look at Apple, and again, we are just going to take assumptions for demonstration purposes here. So let's say there's good support on good resistance on Apple around here. See, there's a series of high lows on the daily around 426, and here 466, and let's say for discussion purposes, there's a big support on Apple at 386 cluster here. Okay? So let's assume you are bullish on Apple. Is this area seems to be okay to you guys to do a put spread? The current price is 428. Is this area 380, 385 like a decent area, everybody, to not gamble? Quick yes, no. First assumption, you start with charts. We are going to run around with Kevin a complete example, and I think it's going to make a lot of sense for everybody. So if you are bullish, a spread around, because I gave my traders last week a 375, 380. But anyway, last week or 2 weeks, just before July 4th. So anyway, let's assume this area seems logic. It's logical on your charts. You don't even need any moving average. You don't need to be a rocket scientist. You don't need any market profile. Just look at the previous high here, previous low here, previous low here, previous low here. It seems that around the 385 there's some interest. So let's say you sell a 380, 375. That seems to be okay to me. And let's say you are bearish. So you have two ways. You could look at it and say, hey, Apple has a hard time passing the 430 right now, which, by the way, if he passes the 430, it's going to fly in the 470. But anyway, let's say you are bearish. Is that area seems to be a good area here? 470, 465. Yes or no? Does that seems to be a good area if you are bearish? Right there for a call spread. Okay. So write it down on a piece of paper, everybody. We're going to look at a 470, 465, and I'm going to show you everything the way we do it systematically and consistently. 375, 380. So the first thing you want to know in the option, so step one, look, we are doing all the steps for you. Step one, look at your chart. Right, Kevin? First and foremost, look at your chart.
Yeah, support and resistance.
Support and resistance. All the professionals, support and resistance. That's what I do every day. Support and resistance.
For beginners, support is where we found buyers before. Resistance is where we found sellers before.
That's it. So here you had some net sellers here, around here, and here you had some net buyers. That's it. That's all it is. So you look at your support and resistance. The second thing, you want to overlay and confirm that. You want to overlay and confirm that, everybody, with the option chain. And that's your delta, the probability in the money. Your option chain, delta, write that down, delta times 100 equal more or less your probability in the money. The delta also is a substitution of stock. I'm not going to complicate that, but the delta is also the move. It's the percentage move on the premium compared to the underlying. So delta times 100 is your probability in the money, everybody. So you want to confirm that by looking at 68% chance to 95% chance of success. Now here's the hardest part, everybody, which is step number 3. See, I'm giving you steps that we do every day with real money, everybody, with real money every day that are consistent. That's the way you have to look at it. Now the later step, you have to look for enough premium. So what is the formula of enough premium? The formula for enough premium in the professional world is 30 to 33% of the width of the strike of your spread. If your spread here on Apple is a 5-point spread, so we are going to do a table at the top left. 1-point spread, like an SPY.
So guys, what is 30% of a 1-point spread? What is 30% of a $1 spread?
Then a 2.5 spread and a 5-point spread. Now we are getting serious, guys. Let's say it's a Netflix, and let's say this is a Google 5-point spread. Okay? What is 33% minimum requirement, minimum premium we want to get before we take the risk to have higher chance of success according to our consistent formula here, which most of the professionals use. Here you want at least 33 cents. Yep. Here you want at least about what, 70 cents, Kevin?
Yep.
And here you want about $1.65 for your month, and that's for your monthly options. If you do monthly spreads, I want to emphasize the weekly spreads. It's another ball game. You can ask us questions next week. I don't want to complicate that. I want to go with the higher probability of success for our community and for everybody on the Real Traders Webinar. So 30 cents, 1-point spread, let's say SPY, 70 cents for a 2.5-point spread wide, and a 5-point wide spread, $1.65 in premium. Now, let me give you the way I do it, and Kevin, jump in if you do it different, for size. Size is everything. I do not risk typically more than $1,000 a spread. So here on the SPY, I'm willing to do a 10 contract spread, But because I never want, and that's always what you need to know, what is the amount at risk I'm willing to risk here? So we give you everything. We give you not only the beautiful strategy that works, but we give you how much you're supposed to collect and how much you're supposed to risk. Let's say for me personally, it's $1,000. I don't risk more than 10 contracts on the SPY, because that gives me a total max loss of about $700 here, which is the 1 point spread minus the 33 cents received. That's my maximum loss. On the 2.5 spread, I changed the numbers of contract, guys, and now I'm doing what? 4 contracts, not 10, but 4, to keep the same loss, max loss level. And now look now on the 5-point spread, everybody, I only do 2 contracts. And that's it. Why? Because now I'm not a gambler. I'm not doing 10, 10, 10, 10. Because your maximum end loss here is $700, let's say $700. It's pretty much consistent, not exactly like this, but pretty much consistent in terms of what you risk. But now, look, if I was to do 10 contracts here, I risk 1K. If I do 10 contracts here, everybody, now I'm risking what? 1,800 or something like this, right, Kevin?
Yep.
And then if I do the trade here, I'm risking 3,000 something. Okay? 3,004 or 3,335 or whatever. That's not the same. I want to be consistent in my losses, everybody. So I adjust the size.
Guys and good. Yeah, that's excellent. Guys and gals, it's so important to survive the learning curve. All right, so that's why $1 wide spread is not only very easy to handle in your mind, all right, a $1 wide spread, but it's also easy to handle in the pocketbook for risk management. If we are taking an 85% probability trade, that means that 8.5 times out of 10 we are correct. Okay, so let's assume that 8 times out of 10 we are correct. All right, just to round it down a little bit. Okay, 8 times $300 credit. Okay, 8 times a $300 credit is $2,400. Okay, that is 24. So let's just say over a 10-week period. Bear with me for a second, Mark. Over a 10-week period, we take this trade every week. That's why we call it an income trade, because we're doing it every week. All right. So let's say we take this trade every week, and we want to make our $300 every week. Okay. And we do. We make our $300 for 8 weeks in a row, and we're like, oh my gosh, this is awesome, right? I just put away $2,400. Okay. And then all of a sudden, the odds catch up with you, and you're wrong 2 weeks in a row, right? You're wrong to the tune of $700, all right? 2 weeks in a row, that's $1,400, okay? So if you'll do the math, $2,400 minus $1,400, okay? I'm still $1,000 ahead over a 10-week period, okay? So, I mean, you know, minus transaction costs, okay? And I just want to remind everybody, this is for educational purposes only. We're not making trade recommendations here, okay? This is for education. But this is an education that is going to change your trading lives. Go ahead, Mark.
By the way, I mean, what you say is very profound. What we are showing you tonight, some people come and they'll say, oh, what the heck are they talking about? It's too complicated. If you really grab it and stick it and listen to it many times, and we'll go on part 2 next week, and we'll show how we defend those, and we'll go a little deeper with the option chain and just the charts. I mean, Kevin is right. I mean, you don't know this strategy can really change your life if you do it properly with the right support and resistance. I mean, this is extra income. I have a trader that works with me who is an attorney. Actually, he is my attorney too, Harry, and he became a student trader. He lost $150,000 for the past 3 years trading the futures. And he started the strategy about 8 months, 9 months ago. He averages about 8 to 10% on his money every month. and he just got a baby, he's an attorney, he put his spreads, and that's it. He go at court, he does his business, he develop his business. I mean, you get a life with that. Not only you get a life, but you get regular income. So let's go quickly to this example. If you are bullish Apple 380, 375, we already saw that on the chart. So the second step is go on the option chain, look for, confirm that it's a 68-95% chance of success, and then we confirm number 3 if we have enough premium. So let's do that, and we will be done on this example, and we'll take all your questions. So now I have Apple, so I put AAPL. Any option chain can give you those information, by the way. And I'm looking for August, and I'm looking for to confirm my assumption that we are going to stay above 380. So I'm looking at the call side around 380, which is right there. What is the probability of staying above 380, 375 within the next 36 days? Do you guys see that? 96 to 85% chance. So those are our assumptions at looking charts just with cluster high, cluster lows for our support and resistance. Even though we use our tools, but do you see that? Yes or no? Do you see the second step, black and white? Do you see it's an 85% chance of success? So our assumption, just looking at a blank chart, you don't even need any indicator or anything fancy. Just the professional on the options market, which are the most astute trader, the market maker and everybody, they assume an 85% chance of success here. So now the next question, which is step number 3, everybody. Can we, within the next 36 days, make enough money for a put spread at this area, 75, 85? So now look what I do. And forget if this is think or swim, and forget if it's TD Ameritrade. Look, I am not biased. You do what you want. I mostly trade on Interactive Broker for commission purposes, because commissions accumulate very, very fast in this business. It's your highest cost of business. People, they always think it's their chart. They always think it's their gurus, but it's not. Your highest cost of business in this business, it will be whether you lose or you make, is going to be your commission. So I go here and I look for vertical spreads. And look what they do. Now they come with the pairs, the 5-point spread, for 10, for 15, for 15, for 20, for 20, for 25. And they give me the net spread that I can expect. So now I go with my pen, and we are looking for a put spread because we are bullish. We want to stay above 380, 385, 375. My question to everybody, and we are going to see if you listen carefully, with 36 days to go, I can get 34 cents or 55 cents if I sell that spread. Is that enough premium according to our rules, everybody? That's step number 3. Step number 1, we looked at the chart with Kevin and you guys. Step number 2, we confirm the probability of success. Step number 3, can we have enough premium to do the trade safely to justify the risk? So I go back again.
This is a $5 wide spread, guys.
Yeah, $5
This
spread.
is a $5 wide spread.
If we
What
apply
credit
the
do we want for $5 wide?
Yeah, good quiz. We said that the formula needs to be 30 to 33% of the width of the strike wide here. It's a 5-point wide spread. So we want a minimum of what, everybody? $1.65, correct. So this trade, even though it answers 2 things, right, Kevin? It answers on the chart, beautiful support, right, Kevin?
Good.
It answers what, Kevin? It answers probability of success above 68%, right?
We wrote down our levels, 375 to 380.
Yep. But it doesn't
probability.
answer. Yeah, but it doesn't answer the last criteria that we need. It doesn't give us enough premium to take the risk. So now, guys, here's what happened. If we have to take a risk now, we have to go and look where it is. Is this level here giving us about the money that we need with 36 days to go right there? The 410, 415 or the 415, 420? Yes or no? Yeah? But here's what happened. Look, this is where you start doing real example, real life here. Not the BS just of the... Because we had to do the slide, guys. You need to start something because a lot of people don't understand spread, and in order for us to do properly the job, to change everybody's thinking and hopefully lives here and the way you trade and your results, we need to start with a minimum of theory, which is break even, max profit, max loss, and now we are digging into the cool stuff. So now if you look at the current price, it's 427, and the 420 425 gives me a $2, and the 415 420 give me a $1.85, and let's say the 410 450 can give me the 165 right here, Kevin. 415 410. My question to everybody, what is it that we need to look now? We need to go back in the probability and see if that 415 410 makes sense, everybody. So we go back to the delta, your probability in the money. So we have to go back into the single options, and we have to see if the probability of staying above 415 makes sense. So I go 415, I go across. What is the probability on the call side to stay above 415? It's 59%. Is it enough, everybody, according to the formula we want? We want at least 68, 66 to 95. It's not. So now we are like, shit, we don't have enough premium where we want, and where we do have enough premium, we don't have enough probability of success. So what to do?
Let's go back to the chart.
Yes, let's go back to the charts.
Okay, so what happens is when you guys get to the guys and gals, when you get to this situation, right, and you're reading the option chain, okay, then go back to the chart, double check yourself. Did I write those numbers down correct? Oh my gosh, I wrote those numbers down correctly. All right, now this is where some personal discipline comes in. Go ahead, Mark.
Okay, so now we wrote those numbers here, and unfortunately this is a great number around the 375, not enough premium. I go around here and it tells me, see if I have a little low, a little high around this 420. So there was a little action here around the 420, we can say safely here, but it's not the greatest support or resistance. So the proposed spread is right there, 410, 415, and I'm going to do those in green colors so that you guys see that those are the spread level. The problem with those spread level right there is what, everybody? It has only 59% chance of success. So one thing that you can do, ideally you want to sell those for the week or for the month because you want the time decay to work in your favor as fast as possible. Another way you can do it, it's buy time. So you can look in the option chain and say, well, in August, guys, doesn't work out. So I go here, close August, and you could go, I'll show you this at the bottom after. You go to September now. Go to September with 71 days to go. And what is the probability? Yeah, so you do the same exercise. See, what's the probability of staying above 400? 68%. Is that 68% okay for everybody? Is that the minimum we want? Right there. 68, 71%, which would be a 395, 400 spread. So look what we do now. If you buy a little time, but ideally you don't want that. You want to do the monthly and the weeklies because the quicker it goes to expiration, the quicker the time value crush to nothing. So look what happened now. You go to the verticals and you look at your 395, 400. Are we starting to look better, everybody? It's right there. Are we starting to look better? It's not quite 165, but that start looking better. This area start looking better. You make the premium that you want. And what happened when you do those spreads, everybody? We will teach you because there is also the effect of volatility close to earnings, and you have to be very careful about that before you jump into spreads. There's this thing. Remember, spreads, and I know we are going a little bit above. Kevin here is going to kill us. The other Kevin at Real Traders Webinar. The option premium has three components. Remember, everyone, we have real value, time value, and volatility, and we are a seller of options. So instead of buying that entire thing at $1, we sell it at $1. So ideally, if the time value goes to 0 by expiration, that's great. That helps us to lower that $1 to 70 cents. You remember? But there's another component. If that volatility represents 20 cents on the $1, and that volatility is towards the high end of the range of your 52-week high, 52-week low volatility, that 20 cents is going to go also going down. And that will help your entire spread to go down and make money. So what you always want to do before you buy options or sell options is look at volatility. And those statistics are being given by any broker, you know, interactive broker. Those guys here, same. There's a 52-week high for Apple here at 45%, and there is a 52-week low at 59.9%. That's the range of volatility. And it gives you the current implied volatility at 31. So everybody, if we're at 31 right now on Apple, are we towards the high range or the low range of the volatility on Apple? Remember, the volatility, it's nothing else than a range for the year that people are predicting with the current implied volatility. Are we towards the low, the high, the high? If you are towards the low of the range, it means that the volatility is low and a higher probability to expand and to increase your premium. That's not a good time to sell your credit spread. If it is towards the high range of the 52-week high, like that 45%, you have a high probability to go down. But there's an effect that you guys must be aware of, especially the guys who know what credit spread are, but you are not professional at them, is that towards earnings season, the volatility goes up, 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 and even break the 52-week high. I've seen Apple going to 90% volatility, right, Kevin?
Yes.
And it goes up, it goes up, it goes up the night prior to the earnings. And what happened is they release the earning the next day and boom, the volatility crashed back down to the normal ranges, and your spreads, if you sell your spread the night before at 90% volatility for 30 cents, just the crush of volatility will bring this thing at 10 cents, assuming you're in the right direction on your break-evens. So you have to be aware. Now we are entering with Kevin in the professional ways of doing this. We are getting more advanced and more advanced in the conversation, and next week it'll be really advanced.
Indeed.
Because we'll take a lot of examples like this.
While you're on this page, Mark, go to the right-hand side and let's just look at the option chain volatility. Just show the audience the option chain volatility on the right-hand side there.
Right there. You see those numbers, guys, right there.
So this is really key over here, guys, okay, guys and gals. So, you know, we'll talk more about that. We'll talk about Iron Condor, earnings play, doing Iron Condor and what's appropriate in the coming weeks. But very exciting stuff. But bottom line is, know when earnings are.
Yes. The bottom line is you need to know the earnings, and you need to understand that as the earnings approaches, it is the worst time to buy options, because you are going to get killed. The spreads are going to wide, the options are going to be really rich, and this is the time where traders, the traders that are not astute that buy options, get killed. And this is why guys like me and like Kevin use probably, I don't know about you, Kevin, but me personally, 50% of all my trades are at least SPY. Why? Because I don't have to go through earnings. Right?
Yeah, yeah.
I don't have to deal with that.
And I mean, I trade SPY, you know, 4 or 5 times a day.
Yeah,
and I'm perfectly happy to do that.
But explain why. Because you make because I am in one of the list with Kevin, and he makes like $2,000 to $20,000 whatever a day or whatever. Tell them why. Why is that, in your opinion? Just the SPY.
Go back to Apple chart, or you can pull up SPY chart if you like. What it is trade location. Okay, so we're talking about support and resistance, and if you can anticipate and view prior resistance, then you know where to sell. And if you can identify and anticipate support, then you know where to buy. And we do this on an intraday basis. And so let's say that, before the FOMC meeting, right? My email that morning said, okay, we're looking for a 1641 low and a 1655 high. Okay, and if you go to FOMC day, our low was 1641 and the high was 1655. And so risk management, if you are disciplined, then you will wait for the appropriate trade location, right? 1641 to buy, all right? And when you get up to the 1655, then you sell up there. Okay?
Oh, hold on. I have the Apple charts in front of me. Am I supposed to put
Oh, I'm sorry. Put ES maybe, huh? If you have ES.
Yeah, because otherwise people don't understand what you are going through here.
Yeah.
There's no visual.
Okay, sorry about that, guys.
Okay, go ahead.
Okay, so zoom in on yesterday, and let's see price action yesterday.
It's
maybe
a daily chart. Do you need a 60
daily
chart?
Yeah, put a 15 or a 60, please.
Yeah, okay. Here you go, 60-minute chart.
Okay, good. All right, so what we had was we had prior levels of support. Where are we at here? Zoom in on. Okay, so prior.
Do you want me to put a cluster right there at 1650 area, 1652? We broke that and it flew. There's a lot of high and lows cluster right there.
Yeah. So what happens is that when you get a congestion area, maybe just draw a rectangle around that congestion area.
Okay. Hold on 1 sec.
I've got my chart up if you want to switch over.
Yes,
Kevin,
if you want, and
yeah,
we can do that quickly. But we are like way past if he's okay, and I think Kevin.
If
Kevin
anybody
sent me a
wants to
message.
see
Yeah, I could do
I'm
it, guys.
happy to share
Hold
it.
on 1 second.
And he says we have to go through question and answers because we are 1 hour and a half already.
You just got to share screen, Kevin.
Okay, good.
Yeah, I gave you
I'll do
the
it.
presenter, Kevin.
Good. This is and so I really like Thinkorswim for charts, and you guys can take a look at the settings on MACD and so forth. Okay, stochastic, TTM squeeze, but basically it's the price action. Price action is king here. Okay, so what we had was pre-market. We were looking at, and here it is right here, is prior levels of support were down at the 1641 level. Okay, this was the overnight low. Okay, so when you're trading SPY or you're trading the E-mini, we prefer SPY just because of the leverage. You get much better leverage on the SPY, and your risk management is much better than trading E-mini. Okay, but this was a prior level where we went sideways, and so there was support down here overnight at the 1641. Okay, and we had a prior high at 1648, and so we were looking for any type of a breakout through this area, and so as soon as price was either we were waiting on news, right? So market's going sideways, and as soon as we got a breakout to the upside, that's the answer to the reaction to the FOMC. Okay, so we could have had downside continuation. I actually had a call spread that I had sold up above the market here. And when I didn't see the downside reaction that we were looking for, I just closed out of the spread. I was a little bit upside down in it, but I closed it out. So the bottom line is understand the big picture, okay, with the hourly chart That's the way we do it with Mark, is looking at the hourly chart, but I start with the monthly, I go to the weekly, the daily, and then zoom in on the hourly. And you see here, these are moving averages. That's like railroad tracks, okay? Parallel railroad tracks. This is an uptrend. There's no sense in fighting the uptrend. If we're in an uptrend, you might as well trade to the long side, okay? So trading with the trend, okay? And buying at prior support where we found buyers before, all right? Where there's a floor in place, okay? Trade placement is good risk management. Okay, good. Go ahead, Mark.
Yeah, Kevin is telling me we need to take some questions. Kevin, do you want to read some of the questions? I think I can read. I have access to the questions.
Yeah, go ahead and read them. I couldn't
Unless
see them.
Kevin wants to jump in, go ahead.
Okay,
Kevin.
Mark, if you could just share your screen. I just made you the presenter again. Just share your screen. And guys, if you guys have any questions, we can take questions now.
Yeah,
So
take
you guys-
take a few questions. We'll be happy to spend another 5-10 minutes in questions. I have my kids waiting me, so
And then next
I have
week
to run.
we can answer some more.
I have to run. I thought it was finishing at 10, but I'll be happy to answer some questions with you guys. So one by one, just slow them down. Let us try to answer one by one. So since we are selling, but as spread trade, no risk of assignment involved. Okay, you want to take this one, the assignment risk, Kevin, on the spreads?
Oh, assignment risk on the spreads. So if you're short any spreads going into okay, so let's say that we take a 30-cent credit on a spread, okay? We're 4 days till expiration, okay? And as soon as we get filled on the spread at 30 cents, okay, then immediately put in a closing trade to buy back the spread at 5 cents, okay? As soon as the spread value goes down to 5 cents, you'll get filled. You'll be first in line, okay, to get filled. So make sure that any shorts are closed out. I just close out the entire spread. But make sure that any shorts are closed out before expiration, okay? And as long as you've got an order then to close out that short spread, you'll never have assignment risk.
There's a good question from Senad. I like that question from Senad. It's a real case spread. He says, I had a 165, 166 call spread today, but the SPY gapped up and jumped in my face pretty much overnight. So I was in pain. The expiration is tomorrow. How would we help him or play it?
Oh, I see.
It's a rollover pretty much. You know?
Yeah, it really is. You get this close, you can hope for a pullback to 1657, 1658 in the morning maybe, you know, but that's about it. You're going to have to you'll get a better price on your rollover if you wait for a pullback. In an uptrend, we probe the lows for 30 minutes to 45 minutes or an hour in the morning, and then we proceed higher. Okay, so that's the pattern we're looking for, guys and gals. In an uptrend, the market probes the lows in the morning. Okay, how low do I go? And then I find buyers. Okay, and where you find buyers, draw a line on your chart. That's called support. Okay, so you know, that's my recommendation, is at the probing of the lows in the morning. All right, to roll that spread over. But you're gonna, I mean, I would I would take the pain and close it out.
Right. A great question. Another, hold on. I'm trying to read the questions as we go. They are being fired at us. Do they have a brokerage account? Tom, if you know that, make sure. Senad, you're welcome. Hold on. He says, is the spread the best strategy in sideways trend? No, in a sideways trend, I mean, personally, if you're really recognizing a sideways market for your instruments, well, next week we'll touch about that. You can do the spread like I showed them tonight. The bottom one and the top one, it's called an iron condor, and you collect the premium at the bottom and you collect the premium at the top. As long as it stays below your break even on the call and above your break-even on the puts, you make a double profit.
Right,
You know?
and the key to an iron condor is timing the trade. As we're probing the highs and finding sellers, that's when we sell the call spread. And as we're probing the lows and finding the buyers, all right, you can write that down. As we're probing the lows and finding the buyers, that's when we put on the put spread. That's when we get the highest value for those two spreads. Together, those two spreads make up what's called an iron condor.
What essentially Kevin is telling you here, guys, and you have to be very careful because there's a lot of gurus that explain it the wrong way, and you have to really be careful about that. Well, obviously I use my own support and resistance tools, but Kevin and I are really big into support and resistance, where we know that most of the professionals are going to look and pie. And then from there, we look at the safety of margin. If you know with the higher than a 60% chance of success to a 65% chance of success where they are going to pile, and you create that buffer zone with the spread, so you go a little bit below or a little bit above with the spread, obviously, you don't need to enter your iron condor all in one. It's a mistake. You leg into it. So you start by one credit spread, either bullish or bearish. If they go, like he said, towards the support, then you start by your put spread because you are bullish. Then they go up, they go up, they go up, they go up, they go up. Then as they go up, there's more premium on the call side. Now you start selling the call side. And then by expiration, they go back to the means. It's like an elastic band, everybody. They stretch up, you release the elastic band, and it comes back to the means of the elastic effect. It's physics, everybody. The price action, the way I always looked at it, and I was taught by some of the greatest traders at my firm, it's all physics. It's like an elastic band. You pull, you release. It comes back to neutral position. So another question.
Mark, the slide for the bell curve, will you put that up, please?
Sure. And hold on, I'm looking for another question. Let me see. I don't even know. Do you guys see the? Hold on. What? I don't even know. Do you guys see the? Which one do you see? Oh, okay. I'm sorry. So where do we have to come back now? The bell curve, right there. Okay, cool.
There we go. Okay. All right. So what happens is that most of price happens right there at the $100, right in the middle, the highest part of the bell curve. Okay. And so part of my discussion next week will be talking about this bell curve and what is price doing. Okay. Price is the fairest value at the $100 mark, all right, on this particular example, okay? The most trades have happened, the most volume of trade has happened here at the fairest price, okay? And then what happens is that price probes down below to 80 and then back up to 100, up to 120 and then back down to 100, okay? So that's what that's what the auction market process is all about. We're trying to probe for fair price. What is fair price? When price goes down to, $70, right? Then, oh my gosh, hey, that's very cheap. I'm going to buy that. And I'm going to buy it up until it's back at fair price, which is $100, okay? So this is what we're experiencing. And when Mark says it's like an elastic band, all right, so let's say that we got over enthusiastic about a particular stock. We bought it down at 70, and it's all the way at about $140 now, right? Oh my gosh, well now all of a sudden it's $150, $152. Hey, guess what? It's going to snap back to $100 because $100 is fair price, okay? So that's what he's talking about the elastic band, okay? When you hear people say price is mean reverting, okay? That means revert. Price is going to go back to the mean. The mean is where value is or fair value is, okay? So yeah.
Yeah, let's take 2 or 3 more questions and let's wrap it up. I think it's like an hour 40 minutes.
We just love this stuff, so go ahead.
Yeah, I mean, yeah, I have my sons. He's on my back and said, "What are you doing, Papa?" So look, quickly, I'm going to try to answer a couple of ones. So there has been some questions. One question from Roger was, when you guys do the spread, do you close out the losing spread completely, or do you close both sides of the spreads, or just the short side? It depends. It depends. Me personally, I close everything, but it depends. If for instance, you have a call spread. Okay, so let me. This is going to be. Okay, if we do a call spread, so it's like this, and this is like Apple. It's a call spread. So you sell this one and you buy this one, and this thing keeps on going up above your break even. This one lose. So some people, what they do is they take this leg out and they keep this leg out because this leg keeps on making money, right? Or they take everything out. I think it's personal preferences. Me, I take everything out, I roll, but there's some occasions where I broke the legs. I'm not really a big fan on breaking legs. What about you, Kevin?
No, that's why they call it a spread, because we're spreading our risk. Okay, we're limiting the risk, and that's the whole beauty to the trade, is you want to limit your downside.
Okay, great. Hey, Beth, thank you for the feedback. I mean, guys, I'm answering, and there's so many feedback coming. Thank you, everyone. Let me see another. Can I go one more question, Kevin?
Okay, go ahead. Yeah, do one more question and we'll wrap it up.
Okay. Oh boy, you guys are going fast. We keep also some of the questions for next week. I mean, we'll be there. We'll take the time to. Hold on.
Yeah, what we'll do is we'll review the questions that are getting submitted, so we know to cover it next week too.
Okay, well, we can do that. Hold on one sec. I'll be there. That was excellent. Thank you. Yeah, thanks for the feedback. I don't just get the question.
Yeah, it's getting buried.
Hold on, it's getting buried as they type, everybody. Well, I guess, listen, guys, thank you for coming. Thanks for Kevin, really to come. Like I mentioned last week, with all the contributors at Real Traders Webinars, we're really trying to bring you some guys that really trade real money every week on the Hangouts, and also do the multi-speakers events and create that community with guys that trade real money. That's the bottom line, you know, to bring you value, education, value, but also guys in the trenches every day, you know. And like I told you, it's not easy to get them. You know, I asked a friend that I know for over 10 years to come, and he said, no, thank you. He said, no, thank you. So, see,
the bottom line is, guys, that we've had mentors before in the past, and that have given us a lot of information, and you know, we're really blessed to be in the position that we're in, and thankful, and so we want to pass that on to you guys. I don't get paid for being here. Just you know, saying thank you to Mark and his audience as well. So appreciate you guys listening up, and I hope it makes a difference in your trading careers.
Thank you very much, everybody. We'll see you next week.
Well, actually, Mark, if I could just answer a couple of questions for everyone. So, guys, just so you know, I've been getting a lot of questions about when the next event's going to be. It's going to be next Thursday, same time, same place. If you already registered for this event, you're automatically registered for the following event. And just so you guys know, for right now, every event for Real Traders Webinar in general will be at Thursdays at 9 p.m. And that's about it. Guys, thank you so much. We let it go a little long tonight, but it's because, I mean, the comments were just overwhelmingly positive. And that's it. Mark, Kevin, thank you so much for such an unbelievable event.
Okay, good night, guys. Be safe.
Good night, guys.
Good night, everyone. Thank you.
Thank you, guys and gals. Be well.
Yes,
Bye-bye.
guys, it has been recorded, and the replay will be out by this weekend.
Bye, everyone.
Have a great night, guys.